And good evening, folks. John Hutchinson with Traders Reserve's Millionaire Blueprint. I'd like to thank you for taking time out of your Thursday evening to join me here tonight. We will get started here in just a minute. I want to make sure I get everything set up correctly here and that we are off and running. I am going solo tonight, so I'll probably need a little assistance, just being patient with me while I get things sorted out here in the next 30 seconds. Got a pretty good crowd already in, so not bad for 7 o'clock on a Thursday evening. If folks would, when you have a second, as I always remind everybody, this is a program that taps into Google Hangouts, and sometimes there are audio or video technical difficulties, delays, what have you. If that does happen to you, or if the audio freezes up or you can't hear correctly, just best thing to do is to log out and then log back in. Usually fixes the problem, but I do want to do a quick audio check and make sure that everybody can hear me okay. So if you would, when you have a second, just type a yes or a Y in the chat box to the right of your screen. Let me know that the audio is coming through okay, and we'll get underway here. And as well, feel free to let me know where you're from. I'm always interested to see how far around the globe our webinars are actually reaching. So always an interesting task. This webinar will be recorded, and we'll give you a link at the conclusion of the webinar tonight so that you can watch the replay should you choose or should you need to. We do have a lot to cover, and I'm going to get through it as quickly as I can. So thanks, Dan. Thanks for letting me know. It sounds like folks can hear me okay. And we're going to be moving along here in about the next 10 to 30 seconds. And looks good. All right, great. Thanks, everybody. Thanks for letting me know. I'm going to dive right in. I do have a lot to present to you this evening. So I will stick around and answer as many questions as you have. As I said, this is being recorded. So you will have an opportunity to go back and rewatch any part. But I am going to sort of drive right through. So as best as possible, if you can hold your questions until the end, that would be very helpful, just so I can make sure that I can answer as many of them as possible. Again, I'm on my own here tonight, so I'm going to go through the presentation and then I'll circle back to answer questions. I do have to make the lawyers happy at the outset here. So U.S. government required disclaimer. Forex future stock and options trading is not appropriate for everyone. There is a substantial risk of loss associated with trading these markets. Losses can and will occur. No system or methodology has ever been developed that can guarantee profits or ensure freedom from losses. No representation or implication is being made that using the Millionaire Blueprint methodology, system, or the information in this presentation will generate profits or ensure freedom from losses. So basically, now that we just told you you're not going to make any money, right? This is exciting. If you happen to enjoy watching paint dry, grass grow, or water boil, feel free to read our entire disclaimer at tradersreserve.com or millionaire-blueprint.com. So we have some great folks here. San Antonio, Terry, great to have you here. Terry, my great grandparents lived down in San Antonio. I loved the Riverwalk, and certainly having a chance to visit the town, the Alamo, of course, obviously. I mean, tourist trap, but love the Riverwalk and area down there. Adelaide, South Australia. Graham, welcome. Alberta, Trent, thank you. Chattanooga, Jim. And looks like we have New York City. Hopefully you didn't get too scared away by that alleged blizzard out there, Robert, excuse me. Austin, Texas. I have other family that lives in Austin. Francis, thanks for joining us. Bob from Phoenix. Good. Looks like AU, I'm assuming, is Australia. John in Panama. How about that? How cool. All right. And we have Virginia and Columbia from Michael, California, Richmond. Wow, all over the place. Vancouver. Excellent. Thanks, everybody. It's great to have you along. Pretty neat to be able to cross continents here. And let's not waste your time. I'm going to dive right in. As you saw in our email, we have a very simple premise in our program, in our webinar here. Our goal is to help turn 250 investors into millionaires. By the end of this webinar, your goal is to be one of them. When you're finished, or when we're finished here, you will have in its entirety the only step-by-step investing plan designed to create millionaires. It includes, and what you will learn tonight, a unique investing plan that accelerates the growth of your money so that you can reach $1 million goal in less time than it takes most people to pay off a car loan. It includes specific yet easy to follow rules so that you automatically secure investing gains and prevent portfolio wrecking losses. It also includes the one number you need to know so that you're always buying the right stocks and avoiding the wrong stocks. When you put these three components together, you will have a powerful yet safe strategy that grows your portfolio by compounding your returns every single month, not annually, monthly. But I want to make absolutely clear that what I'm about to teach you tonight is not about high risk investing, penny stocks, day trading, a get rich quick scheme, forex trading, or real estate speculation. We are and will be focused on investing in stocks and in the stock market, but perhaps not in a way that you might think. Now, I know folks out there are concerned that stocks have gone up so far, so fast since the 2008-2009 crisis. You may be worried that we're on the verge of another bubble. You may not believe that stocks can keep going higher. You may be concerned that you're going to buy the top again, only to get stuck selling the bottom. And you're going to find that I have many of the same concerns. And that's why the importance of what you're about to learn tonight is so powerful, because if you can follow some very simple rules, you'll discover that it doesn't matter whether the market is rising or falling. You'll have a strategy to profit in any market condition. You don't have to worry about buying the top of the market, because our one number strategy, which I'll teach you tonight, ensures that you're buying the right stocks, not the whole market. And that provides you with substantial profit opportunity. You'll also learn that by using this unique investing plan, your portfolio is actually protected. It's shielded against bear markets and huge losses. You'll see why and how in this training session. But you may be curious, at least, about why we've chosen $1 million goal, $1 million as the goal, and not 2 million or 10 or 100. And it's because if you're 40 years old or older, you're likely facing what Forbes magazine calls the greatest retirement crisis in American history. It's one that will leave millions of Americans, at least, poor in their later years. And here's why. The average portfolio in America right now is about $50,000. But to have a secure retirement, you need at least $750,000. And a recent Fidelity Investor survey actually discovered that baby boomers right now face a $24,000 annual income gap in retirement. Yeah, $24,000. To put that in perspective, imagine living the life you lead right now on $24,000 fewer dollars per year. Considering that the average standard of living is about $52,000 per year, you'd end up below the poverty line at around $28,000 per year in retirement. So it's not hyperbole to say that most Americans will be poor in retirement. But that's not all. As you saw this slide just a moment ago, the retirement problem here is based on some really simple math. The average person earns about that $52,000 per year, retires at the age of 67, and lives another 15 years. So just to maintain an average standard of living in retirement, you'd need at least $780,000 in pre-tax dollars. Now, that's $780,000 just for retirement. It doesn't account for such things as vacation or travel or being able to do the things that you want to do when you're retired. It doesn't, if you're a younger investor who still has the dream of home ownership, you're going to need even more money. If you have kids that still need to go to college, or if you're planning to have kids and want to put them through college, ring up the cash register. That's another $100,000 to $150,000 right there in college expenses. And then we have future medical expenses. The AARP recently reported that retirees alone can really expect it to need at least $240,000 to cover future medical costs. So government healthcare notwithstanding, that one category is the fastest growing money killer for retirees. And when you add it all up, it's pretty easy to see why we set an initial goal of $1 million. And once we get there, then we can look at 2, 10, or even more. But we need to get to $1 million first. The problem is you probably don't have $1 million. I know I don't. I know many of our members don't. And you may not be anywhere close to that number right now, but you're not alone. The average portfolio size, as I told you a moment ago, is about $50,000, which means that the average retirement gap is greater than $700,000. So we're a long way from $1 million right now. How will we reach that goal? Well, I'm going to be blunt. You have to invest in individual stocks again. Put simply, you don't have the same low risk choices to balance your portfolio that you did have 5 or 7 years ago. That means that being willing to accept some risk is a necessity. We'll show you how to limit your risk so that you're never in danger of losing it all when you learn our approach. But the biggest takeaway here is that for most investors, time is now their enemy. You don't have those typical 50-year models or 30-year models to invest in. You probably, like most people who attend our webinars, have 5 or 10 or even 0 years until retirement. So if you think stocks are dangerous, you're going to find out that they're less dangerous than bonds, CDs, and savings accounts, all of which have actually crashed, if you will, much worse than the stock market. At least the stock market recovered. Look at these numbers. For so-called safe investments, as part of a balanced portfolio, these safe investments, interest rates on CDs and savings accounts have collapsed 85% since 2008. That's over the last 6 years, 85% lower interest rates on CDs and savings accounts. US Treasuries, safest investment on the planet, those yields are down by 50% and then some. Yet the stock market is breaking into new high territory almost every day. How is that possible, right? Well, first, understand that the stock market is no longer just buy and hold. It doesn't mean that buy and hold is dead. It isn't, but high frequency trading, computer algorithms, computer-based trading, they've all created this faster trading world on Wall Street, not the investing landscape that we had about 20 years ago, that we were used to about 20 years ago, which means as an investor, you need to make some simple changes or risk being left behind, or worse, risk relying on the government in your retirement years. Now, I want to help you prevent that from happening. So a quick introduction. My name is John Hutchinson, and I'm the creator of the Millionaire Blueprint and the investing strategy that you're about to learn. I'm also a published author. My book, The Wealth Shield, How to Invest and Protect Your Money, can be found on Amazon.com. And I'm also one of the publishers here at Traders Reserve and Main Street Investor. But I'm best known as a wealth building expert and strategist who helps people restore their retirement dreams while protecting their wealth from risky or get-rich-quick schemes. So enough about me. Let's talk about you. Let's dive in. We were talking about stocks and the need to embrace some changes. And one of the things I continue to see is that despite the rebound in the stock market, most investors today are still making serious mistakes with their money and the way that they invest. And it's the key reason most investors are having a hard time getting their portfolios to grow. And there's a reason for that. It's because most investors are following the exact same investing models of the last 15 years, whether it's buy and hold, diversifying between stocks, bonds, and mutual funds. But here's the reality. In that 15 years, the average return for most investors is less than 3% per year. And future returns, based on economic forecasts, are expected to be around 7% per year. Now, you might think that 7% per year sounds pretty good until you realize this fact. At 7% per year, you could put $10,000 every single year into the stock market, and it would still take you 30 years to reach $1 million goal. Now, that's if you put $10,000 into the market every single year, and if you got that 7% per year every single year. Not only are there too many ifs in that scenario, most investors simply don't have 30 years to wait. Now, investors who want to achieve their retirement goals and still believe in the retirement dream, you know you can't just buy and hold. You have to do something different. But what is that something different? Because if buy and hold isn't dead, what is it? Well, keep in mind that it's those buy and hold models that are projected to return that 7% per year. And we've just sort of shown you that that's not going to get it done for you. But if you can follow some pretty simple rules, in 8 years or less, this could be your portfolio. Now, that's $1 million in about 8 years. I expect you to be a little skeptical, but the purpose of this education tonight is to show you how it's done. And first, it's done by making one simple change in how you think about your portfolio. And that change is to think in terms of time. Now, in order to reach your financial goals, your portfolio should be structured based on how long you want to hold an investment with a specific profit objective in mind. I'll teach you that in just a few slides. But tonight, what we're going to talk about is how to use short-term investing in stocks, not day trading, but short-term investing in stocks to accelerate returns by compounding gains monthly, not annually, monthly. That allows you to grow your portfolio faster than you've probably ever experienced before. Now, to do this, you can use just part of your total portfolio. You don't have to bet the farm. You don't have to go all in. But depending upon your total capital available, you could use as little as about 10% of your total portfolio. But that allows you to get explosive growth in your money and still keep your portfolio safe. And what you'll discover here is you can actually hold fewer stocks in your portfolio so that this doesn't take hours of time for you to manage your money. But that brings me to a very important lesson. We're going to be talking about our unique hyper compounding principle here in a moment, but I would like you to try to write this down if you can. It's one of the lessons that I keep teaching investors I talk to, and it's that the key to successfully growing your portfolio is determined by increasing the annualized rate of return on your money. Let me give you an example. This chart shows you how your money would have grown if you had simply invested in an S&P 500 index fund over the last 15 years. That's something that hundreds of thousands of investors have done and actually are still doing. Now, you may have heard that obviously the market's making new highs, so you probably think this means that you'd be raking it in if you had bought and held this index fund. But the truth is exactly the opposite. It's the great lie about buy and hold and index funds. It actually tends to decrease your annualized rate of return, not increase it. Now, sure, the market was up 25% in 2009, 30% a year ago. But over the last 15 years, if you put $10,000 every single year into an index fund, the S&P 500, your actual rate of return was less than 3% per year. And at that rate, it would take you nearly 60 years to reach $1 million portfolio. 60 years. Now, along with savings accounts, CDs, bonds, and now index funds, you're probably wondering, how on earth are we ever going to get to $1 million portfolio, right? It's called hyper compounding, and you can do it safely. You can do it consistently in your portfolio, whether you hold an IRA, a Roth, a regular brokerage investing account. If you can buy and sell a stock, then you can use this hyper compounding strategy. I'm going to teach it to you right now. It's very simple to understand. It's a strategy to increase the annual rate of return on your money by compounding your gains every month instead of every year. So let me demonstrate the power of this to you, and I'll use basic linear math just so everybody understands it. Let's assume that you were starting with $10,000 and you get an average return per month from your investments of 4% per month, not per year, but per month. After 12 months, you'd have $16,000. That's an annual return of 60%. Now, that 4% per month is essentially the compounding strategy. Here's the hyper. If you follow that same plan for a second year, starting with your $16,000 and still generating that same 4% return per month, your money would grow to over $26,650 at the end of the second year. And your annualized rate of return has increased to 83%. Now, notice also that in just those 2 years, you also more than doubled your money, but you never added a single penny. You started with a finite amount of money, $10,000. You generated a return per month that compounded that money rapidly, doubled that money in 2 years, and you never had to add a single penny to that amount. All right. That's the power of hyper compounding in action. Now, I want to get into the simple details behind the Millionaire Blueprint's Power Portfolio Plan so that you can see how to use this and put this idea of hyper compounding to work for you. Step one is to determine how much money you can start with. Now, remember, you're going to be investing in the short-term part of your portfolio first. That's where we're focused here tonight. Now, the most important point here, however, especially is if you have a larger portfolio, you do not have to take ridiculous risks with your money. You can take just a small part, maybe 10% of your total portfolio, and allocate it to your short-term investing account, if you will. If possible, and this will make sense in just a moment, if you can start with $10,000, that's the best place to begin. Nice even number. We've had people, however, who have been successful using this plan start with as little as $2,500. I'll give you some more tips on that a little bit later in the presentation here. Now, the reason you're doing this, though, is for risk management purposes. When you put these two steps together, it will ensure that no single stock in your portfolio can ever hurt you or wreck your entire portfolio. If you have less money to begin with, however, I will be honest, you're going to have to take on a little more risk. And the reason is because you need faster growth to get to that $10,000 point. Again, more on that a little later. But the next step, once you've determined what your short-term investing capital is to divide that capital into 10 equally weighted capital groups or buckets. So if you're starting with $10,000, you then divide that into 10 buckets. You'd have 10 buckets of $1,000 each. Each bucket then holds one stock at a time, so the maximum number of stocks you'd ever hold is 10. This is an additional risk management tool that reduces your overall risk exposure even more, and again, protects your portfolio from those potential big losses like the ones that most people experienced back in 2008 and 2009. Now, those are the two key steps to get started with the plan. You're beginning with short-term investing so that you get fast growth of your money and begin that hyper compounding process by turning in percentages each month, and the money you make in month one gets compounded in month two, and then compounded in month three, etc. And you'll discover that effectively many of your short-term investments will typically be held between 30 and 90 days, which creates that short-term return. Now, remember, we're not day trading here. We're not advocating day trading. Short-term investments those are assets that you'd hold for 30 to 90 days. But there's more to our power profit portfolio concept here, which includes the ability to roll a stock up to a medium-term or long-term part of your portfolio. Now, we'll only be focusing on the short-term part in this training session, so we can keep it simple tonight. But here are some things that you can expect to happen in the future. Some of your short-term stocks could actually be held for up to 6 months for double the original profit potential. Some medium-term stocks, those that you're holding 6 months, can actually be held up for 1 year for up to 5 times the profit potential. And all the while, every month, you'd still be investing in that short-term part of your portfolio to get those monthly returns, to get the hyper compounding you need for the fast growth of your money. Now, again, as I said, and I know I repeat myself frequently with this one, it's not day trading. These are short-term investments that are stocks or ETFs that you're holding from 1 to 3 months, but most importantly, have a specific profit objective or target. And we're coming to that in just a moment in the rules section, so hold tight. Now, once that profit objective is reached, you take your gains and repeat the process. This is how you tap into monthly compounding. In our Millionaire Blueprint program, we target between 2 and 8% returns each month, which gives us a potential annual rate of return of 80%. Now, what you'll discover is that you'll make more money faster with just part of your portfolio using short-term investing with these goals in mind, and never risk losing it all. But that brings me to the second of the deadly and costly mistakes that most investors make, and it segues us into the rules part of the training. So this is step 2. I just shared with you the plan and the concept behind hyper compounding. Now I'm going to take you deep inside the very easy to use rules. The first thing I want to cover, though, is the mistake that investors are making, and that I see it with investors and traders, and that's that hope is not a strategy. To be successful with this or any investment plan, you must have 3 things: a simple, repeatable plan to come out ahead, easy to follow rules that don't take a lot of time, and a smart way to protect your money. But you may wonder, well, why do most people actually lose money? In a single word, emotion. To understand why, I'll share a quick little story here. A number of years ago, I was on a flight out to Las Vegas, and I was sitting next to a guy from New York. It turned out he was a very successful business person. We were talking about gambling, and I asked him why he thought most people lose money in Las Vegas. And here's what he said. He said, people lose money because they don't have triggers to quit. Their emotional highs or lows actually get in the way of making a rational decision. He said, I have 2 triggers, a profit trigger and a loss trigger. Whichever one I hit first, I pull that trigger and leave the tables for the night. Well, the more I thought about that idea, the more I realized that it's the same principle when you invest, right? You must have triggers. But most people don't have a loss trigger, they have a hope trigger. They just hope that the stock will come back. And they certainly don't have a profit trigger. They just hope that the stock keeps going higher. I mean, think about the last time you bought a stock. Did you think to yourself any of these? Well, I hope this works out. Or have you ever had a stock that fell by 10 or 20 or 30%? You said, well, I hope it comes back. Or maybe you bought a stock and it started going up that 10 or 20 or 30%. And you said, come on, baby, keep going higher, right? What happened next? The stock would go down, give back all your gains, and then you're back to square one. So you should be able to see here why hope is a recipe for disaster, how it can wreck people's money. That's the emotional interference in the investing world today. As part of our Millionaire Blueprint rules, however, I'm going to give you the key to success, and that's to remove emotion from the equation. Now, I'll be totally honest with you. I get excited too when I have a stock that goes up, and I get mad when I have a stock that goes down. It's a natural response. But by using what we call decision triggers, we can remove emotion from the equation. And by emotion, I mean the deadly trio: fear, greed, or hope. By using profit triggers and loss triggers, you can establish your profit target and your risk in advance so that you can automatically secure an investment gain or protect yourself from a big loss. And the reason is because when you learn to use decision triggers, you are making your decisions before you ever commit your money to the stock market or any investment for that matter. I'll say that again. With these two triggers, a profit trigger and a loss trigger, your decisions are made before you ever put money in the stock market. Now, let me teach you our Millionaire Blueprint 2010 rules to investing. And in just a few minutes, I'll even share some trade examples so that you can see decision triggers in action and how they do exactly what I just told you: secure investing gains and protect you from big losses. So let's quickly review the plan again. I just want to walk right back through these two quick steps here. Remember, the first two steps were to determine your short-term investing capital base. For the rest of this part of the presentation, we'll just assume $10,000 for our teaching purposes here. The next step was you divided that $10,000 into 10 buckets. So each bucket would be $1,000. Now, next, we need to set our decision triggers. We need to make our decisions before we commit our money to the market. Now, those triggers for our short-term investments are a 20% profit trigger and a 10% loss trigger. Every stock that we're investing in for short-term investing has the same profit and loss triggers. I told you earlier that this is short-term investing with a specific profit objective. That's your profit objective, 20%. Now, that's how you secure those investing gains, and the loss trigger is how you prevent big losses. You'll use decision triggers to make the only important decisions that you need to make. When you hit your 20% target, you want to take your gains so that you start the hyper compounding process. Imagine if you have $1,000, you make 20% on that in 1 month, and it's possible. You can. I'll prove it to you in a little bit. And then you now have $1,200 going into the next month, and you get another 20% gain. Well, instead of going from that $200 gain, you're now actually going to make $240 because you're compounding the money you just made in the first month. So your money grows from $1,000 in the first month. After that first 20% gain, you have $1,200. After the second 20% gain, you have $1,440. That's how rapidly you can grow your money when you follow these decision triggers and this plan. Now, the main benefit to your money here is you also make sure that you don't give back a gain. And by give back, I mean give back that whole 20%. That's why when your 20% trigger is hit, you exit the trade, take your gain, and move on to the next opportunity. Now, you also have to protect your money. And to do that, you have a 10% loss trigger. Now, let me be clear on something here. A loss trigger does not have to be a stop loss order. In many cases, it should not be a stop loss order. And the reason, especially with smaller cap stocks out there, is to prevent market makers from driving prices down and taking your stop loss out and forcing you out of a stock. But at 10% below your entry price, this gives you more than enough time to analyze your stock and ask yourself, are the fundamental reasons for owning the stock still true? Has the company recently reported negative news? If so, when this particular trigger is breached, maybe that is the time to preserve capital and move on to another opportunity. Now, simply put, that 10% loss trigger helps you to ensure that you never let a small loss turn into a big loss. And that's exactly what happened for most investors in 2008, 2009. They watched the stocks drop 20, 40, even 80% in value and never protected themselves with a loss trigger. Now, you can obviously, especially with larger cap stocks, you can use stop losses usually without any interference, because there's so much volume in the stock that you're not going to get that kind of monkey business, if you will. But with small caps, sometimes you have to be a little careful. But more importantly, that 10% loss trigger gives you a chance to look at the stock and say yes or no, thumbs up, thumbs down, I'm in or I'm out, and make a decision, and make that decision, stick to it, and move on. If worst case, you're preserving 90% of your capital. That's the worst case. Now, when you put all of this together, the plan and the rules, basically what you're going to learn is that you don't have to be afraid of hitting singles and doubles. Winning in the markets is just like playing baseball. You'll score more often and with more realistic gains by consistently hitting those singles and doubles rather than swinging for the home run trade at every at bat. So in a nutshell, and in relatively quick order, that covers the plan and the rules, basically the reason why you need to have $1 million. Next up, I want to talk about the final piece of the puzzle, which is finding the right stocks to use with your new power portfolio and the 2010 rules. Now, generally, or usually at this point, I introduce our Millionaire Blueprint investing expert, Jamie DeLugash. Jamie's daughter is having a birthday tonight, so I will do my impersonation, if you will, on how we find the right stocks inside the Millionaire Blueprints program. Now, if you don't know Jamie, and to give you some of his quick background on why he's an investing expert, he's a 25-year veteran of the stock market and an investment professional. Holbert Financial Digest previously ranked his Rational Investor a #1 newsletter. He currently writes for such reputable websites as Traders Reserve, Main Street Investor, MSN Money, and others. He's also the author of a forthcoming book called The Manipulators, Beating Wall Street's Earnings Game, which is due out next month on Amazon.com. Now, the process that Jamie uses to find the right stocks centers on one number. You'll learn how simple this number is to calculate in just a moment. But as the expert in the Millionaire Blueprint program, he uses a computer-based algorithm which ranks all of the publicly traded companies at the end of each month. He then reviews those rankings, by sector and by market cap, so that he avoids overexposure to any one sector or any one market cap, so that he doesn't have just large cap or just small cap stocks. And then he'll use a qualitative analysis approach to re-rank stocks into his top 10 stocks each month. Now, remember, in our plan, we had $10,000 and we divided it into 10 buckets. You can see here that by coming up with a top 10 stocks each month gives us an opportunity on a month-by-month basis to fill all 10 of our buckets. Now, these are the 10 stocks that you would use, these are the 10 stocks that you would use in your short-term investing portfolio, and they're all based on one number, which is used to identify the best stocks to own. That one number, is what we call the PE gap. Now, this is very simple, so just bear with me. I'll show you how easy this number is. It's ridiculously simple. The PE gap, though, it occurs when there is a difference between the company's PE ratio and the company's earnings growth rate. Quite simply, the PE ratio is what's used to determine the valuation of the company, the value of the company. What you're looking for are companies that are undervalued relative to future earnings growth. Very important. You don't want overvalued relative to future. You want companies that are undervalued today based on what those companies will make in terms of money 6 months, 12 months, 5 years from now. So again, don't worry about getting all bleary-eyed here. It's very simple. I'll show you how easy it is to calculate this in just a minute. But what you're looking for is when the PE ratio is greater than the earnings growth rate, that means you have an overvalued stock. That's a stock you either want to avoid or potentially short. When the PE ratio is less than the earnings growth rate, that means that you have an undervalued stock, and that's one that you'll typically want to buy. Now, a little tip, and you'll see this in a moment, the wider the gap between the PE ratio and the earnings growth rate, the better the profit opportunity can be. And that's because we frequently see PE gaps trigger gains of 15 to 30% in short-term investing timeframes. And if you think back to our rules and our triggers, what was our profit trigger? 20%, which is right in the sweet spot of the types of gains we consistently see in undervalued stocks using the PE gaps one number approach. So let's take a quick look at a quick example here, and then I'll teach you how simple this one number is to get. Now, this is a company called Manitowoc. The stock symbol is MTW. They're a heavy crane manufacturer. It's a stock which our PE gap approach identified at the end of November 2013. At the time, the stock had a PE ratio of 16, an earnings growth rate of 19, which gave us a -3 PE gap. Now, again, when the PE ratio is less than the earnings growth rate, we have an undervalued stock that we want to buy. That'll always show up as a negative PE gap. I'll give you the quick tips on that in a second. But here we recommended Manitowoc at the beginning of December 2013 with an entry price of $20.59. This was an actual recommendation in our Millionaire Blueprint program. And you can see how rapidly the stock was repriced by Wall Street. In just 30 days, the stock hit its 20% profit trigger. And for some of our followers, they held on longer and actually enjoyed double that return in about 90 days. That's how powerful this very simple approach can be for you. Fast gains, which you then turn over into another stock for another gain, month after month after month. But let's get back to the lesson on PE gaps here. Here's the quick lesson and the easy way to know what to do. When the PE gap is negative, that means that the PE ratio is less than the earnings growth rate, which means the company is undervalued today against the future expectations of the company. That's a stock you want to buy. When the PE ratio is, when the PE gap is positive, that means the PE ratio is greater than the earnings growth rate. That's bad, which means the company is overvalued, and that's a stock you want to avoid or potentially short. Now, we do not short stocks in our Millionaire Blueprint program. I'll give you more details on that in a little bit. But for those who like to play both sides of the market, you now have a very powerful little weapon to find potential trades that you can make. Now, last but not least, remember I said earlier that the wider the gap between the PE ratio and the earnings growth rate, the better the opportunity for short-term gains. Good. Now, let me show you how simple the PE gap is to calculate, and then I'll walk you through some examples and some sample trades. You can do this right at home with me. First and foremost, we use Yahoo Finance to get the numbers that we need. They're readily available on any financial portal, but there are only 3 numbers that you need. Now, I'll come back to that in just a second. For those who may be playing around with this at home, here's how to get where you need to go and to sort of follow along with an example. If you're on Yahoo, you type in your ticker symbol, and then when it takes you to that ticker symbol's main page, that main investment page, you scroll down the left side, the left-hand menu until you see Analyst Estimates. That's the tab that you want to get to in order to get 2 of the numbers you need, which are your earnings estimates. So the 3 numbers that you need, and we're using American Airlines here in our example. Once you're on that Analyst Estimate page, you can see the 3 numbers I've outlined for you here in red. You need the current stock price, the current year's earnings estimates, and the next year's earnings estimates. Now, the current price in this example was $51.40. The current year's earnings estimates were $5.72, and the next year's earnings estimates were $8.42. For those who are paying attention at home, please note this snapshot was taken on December 22nd, 2014. It's the process that is important here, not those specific numbers. So just so everybody is full disclosure, this was from last month. Now, we have the 3 numbers that we need, and we can basically move on to our 5th grade math lesson. Yep, this is so simple, a 5th grader could do it. First, you calculate the price to earnings ratio. To do this, you divide the current price by the current year's earnings estimate. So with our American Airlines example, that's $51.40 divided by $5.72, which gives us a PE ratio of 9. Now, hold on to that number for a minute. We'll come right back to it, because next we need the earnings growth rate. To get that number, you divide next year's earnings estimates by the current year's earnings estimates. So back to American Airlines we go here. That would be $8.42 divided by $5.72, which equals 1.47. To get a percentage, you subtract 1, which means we would have an earnings growth rate of 47%. So now let's hold on to that number. So we have two numbers we need to hold on to here, 9 and 47. Now all we have to do is calculate the PE gap. Here's how hard that is. It's the PE ratio minus the earnings growth rate. That equals the PE gap. So if you can divide and subtract, you can calculate the PE gap at home on any stock that you hold or want to look up. So for American Airlines, we had a PE ratio of 9 minus the earnings growth rate of 47. Now, you don't need the percent there. You just need the raw number, because what we're looking at is the difference between those two numbers. So here we had a negative PE gap of minus 38. So again, our gap is negative, which obviously means the company is undervalued, and we would want to buy this stock at current prices. Now, let me bring everything together for you here from the whole training session here, the plan, the rules, the right stocks. I want you to see everything in action from start to finish. So I'm going to go back to American Airlines. I'm actually going to go back in time a little bit to the end of September of 2014, just 4 months ago. Now, this was one of our recommendations for heading into the month of October. So we would have used one of our capital buckets to buy this stock at the market open on the first trading day of October, October 1, 2014. The opening price on that day was $34.50. So I've already given away how this trade actually turns out if you were paying attention on the last couple of screens, but let's go through all of this step by step anyway. First, remember, once we've identified a stock, we have a bucket available to put that stock into. The next step is to make our decisions before we commit to the market, which means we need to set our profit and loss triggers. Here's how easy they are to get. For our profit trigger, you multiply your entry price by 1.2. That's a 20% gain. So here that's $34.50 times 1.2, which equals $41.40. That's our profit trigger. Next is our loss trigger. You multiply your entry price by 0.9, and here that's $34.50 times 0.9, which equals $31.05. That's our loss trigger. Finally, we step back, we let the market do the work for us, and let the trade run to conclusion. But before I get to that, I want to share a little secret with you. Something that we do in our Millionaire Blueprint program that you can learn to do and want to learn to do as well. Remember earlier we talked about triggers. I told you that it's a decision trigger and that you have to assess whether something fundamental has changed with your stock when that trigger is, especially when the loss trigger is reached or even breached. In our program, for our members of the Millionaire Blueprint family, that's what we do for them. When a stock gets to that 10% floor, we're instantly advising our members whether to close the trade or hold the trade and the fundamental reason for doing so. Now, here with American Airlines, I'm going to throw up a chart for you. You see that big red dip at the outset of October? Remember, we would have bought our shares of American Airlines on October 1 at $34.50, right? And you can pretty much see, boom, right up to the 13th of October, big red dip. That would have been well below the $31.05 loss trigger. But can anyone remember the CNN and MSNBC hysteria at the beginning of October? Does Ebola ring a bell? Recall the healthcare worker from Texas who took a commercial flight to Cleveland while exposed to the Ebola virus? You're looking at 6 days right there of headline selling. That's news selling. In other words, mass hysteria, which translated into all stocks in the airline sector being sold off by 15 to 25% in 1 week. So what did we do? We sat tight. Why? Because nothing fundamentally had changed about American Airlines. Earnings expectations did not change. Oil prices were just beginning their acceleration down, which meant more profits for the airlines. Passenger traffic for that time did not change one bit. So we sat tight, and we were right. Within 20 days following that headline hysteria, we were at our 20% profit target. 20 days. And so were our members. Our members held on too. But that Wasn't enough for us. You'll recall in the pie chart earlier, I showed you there were also medium and long-term parts of the power profit portfolio. We moved American Airlines to the medium term and increased our profit target to 40%. So we're still following the same simple rules. We just doubled our profit target. And within another 30 days, we had that 40% profit target reached. So within 60 days, we were down 15% and then ahead 40% by picking the right stocks based on that one number. That one number was a negative 38. Remember, I told you the wider that gap is, the better the profit opportunity. There's 40% in 60 days right there. Now, it's still not enough for us, so we have actually moved American Airlines to the long-term part of our portfolio, where it currently has a running return of 55% with a profit target of 100% gains. So $69 is our profit target on that one. So that's a little bit of fun stuff. I wanted you to sort of get a real flavor for how this concept can work for you, not only in just a short term. You could just have taken your 20% and moved on to another stock in November. You could have held on for just the medium term, take your 40%, which is pretty phenomenal, and then boom, move on to another stock. Now I'm going to show you the losing side. That's right, I'm going to show you the losing side and how the plan and the rules protect you from those portfolio wrecking losses. This is a company called US Silica. SLCA is the stock symbol. It was a November 2014 recommendation. At the time, it had a negative 35 PE gap. Big gap, obviously. However, we were cautious on this one because it's tied to the oil industry. And obviously, at the time, oil prices were pretty much under siege. Nevertheless, we had an opportunity, and we took it. So once again, let's make our decisions first. We calculate our profit trigger and our loss trigger. So the opening price on the first day of November was $45.57. So our profit trigger was $54.68, and our loss trigger was $41.01. So we set our ceiling and our floor. We're following our rules. We have a fundamental basis for making this trade. Let's see what happens next. Ouch. That's what happened. And here's what we did. Now, oil started right at the beginning of November. It fell dramatically. So within 2 days, our 10% loss trigger had been breached. What did we tell our Millionaire Blueprint family members to do? We told them to close the trade. Why? Because the fundamental reason for making the trade, stabilization in oil prices, did not and was not happening. Ultimately, we closed the trade the next day for about an 8.5% loss. So let me put that into context for you, into a dollar context. Remember, if you started with $10,000, you divided that into 10 capital groups, which means you would have used $1,000 on US Silica and even American Airlines before it. With that 10% loss trigger in place, that means your maximum loss in terms of dollars is $100. That's your maximum risk, $100. That's it. $100 is 1%, just 1% of your total short-term investing portfolio. So you should be able to see, just from those numbers and understanding how small that they are, that one losing trade or even several losing trades will not wreck your portfolio. More to the point, and as an opposite call on American Airlines, look at what would have happened if you had held on to this trade. By the end of November, the stock was all the way down to $28 a share, which means we saved ourselves and our members from a potential 34% loss by executing our decision trigger and taking that small 10% loss. And in the process, we preserved 90% of our capital for the very next trade. Now, however, lest you let one losing trade get you down, in the very same month of November, we also recommended automotive supplier Meritor, stock symbol MTOR, which had a negative 20 PE gap at the time of the recommendation. Back to the rules we go. We set our decision triggers based on the market open price. At the same time that we would have entered US Silica, November 3rd. At the time, that price was $11.55. So our profit trigger was $13.86, and our loss trigger was $10.40. Once the decisions are made, we let the market do the work for us, and boom, it happens that fast. 9 days later, we had a winner, 20% winner. Ultimately, we moved this one to our medium-term portfolio as well, where it was still holding its gains on the way to a 40% target. So in the same month, you would have had a trade that lost 8.5% or $85, and one trade here that would have gained 20% or $200. So across those two trades, you would still be ahead by $115 or 1.5%, 1.15%. Now, we even had 8 additional trades running in November. So I'm just showing you a couple of the pieces of the puzzle. I'll show you how the full month ended up in just a moment. But you can see across just 2 trades, that's a 1.15% gain on your portfolio. And remember that we're targeting with our short-term investing 2 to 8% gains each month. So we've already got 1.15, and I haven't even shown you the other 8 trades for the month. So again, we'll put the pieces of that puzzle together for you in a minute, but you should be able to see now how powerful this plan, the rules, the right stocks, all of it can be when you adopt this approach. Let's take a brief look, though, at the whole month of trades from December. This is just last month, so I'm going to go all the way back to the start. We're going to actually look at the 10 stocks here very quickly. These are the ones that we recommended. Here are the calculations of the PE gaps. This is the work that we do for the members of our Millionaire Blueprint family every month. So basically, we do all the work for you, and you push a couple of buttons, you lucky devils. But look at the spread of gaps here, from -7 all the way up to -128. Remember, the key behind this gap, the reason it matters, is because it's telling you that there is an inverse relationship to the company's future value based on the price of the company today. It doesn't mean the stock is cheap. It means the stock is undervalued based on what it should be worth in the future. And how is Wall Street pricing stocks on the stock market? Based on the future value of the company. So when you have a tool that tells you that a stock is undervalued relative to its future value, you are playing Wall Street's game. You are singing their song, dancing their dance, if you will. Now, you also notice, too, when you look at some of these names, these aren't penny stocks. They're not OTCs or pink sheet stocks. I mean, you've got USG, that's a home builder. Sportsman's Warehouse and Kate Spade, those are retailers. Those are bricks and mortar retailers. Whirlpool, WHR, Whirlpool. Everybody knows Whirlpool. So you have a range of stock types and sectors and market caps here. But here's what would have happened for you. Again, bringing everything together for you, if you had $10,000, 10 individual buckets of $1,000 each, and you applied it to those 10 stocks in the month of December, here's what would have happened. You would have invested a total amount of capital of $9,691. That's over on the right side here. That's the starting value based on essentially taking the share prices and dividing them by $1,000 per bucket. That's what you would actually have started out with. So you would have had excess cash of about $308. You would have paid commissions. So I'm accounting for commissions here. So your actual beginning account value after deducting commissions and investing in all 10 of those stocks is $99.30.50. Now, again, note, I'm making this as real world as possible. So I'm accounting for cash, I'm accounting for commissions, but by the end of December, those 10 stocks, which included one of them, Kate, being closed at a 9% loss, had a total value for you of $10,166 for the month, which means for the month, in 1 month, just 1 month, you would have made 4.9% on your portfolio. That's 4.9% in 1 month. Now, what did I tell you earlier most investors are making per year? 3%, right? There's 4.9% in 1 month. That's nothing. Remember November? Look at the bottom of the chart on the left side there. 7.7% for the month. That included closing the U.S. Silica trade with an 8.5% loss. In the 16 months this program has been running, we are averaging 6.6% per month. If you started today with $10,000 and you stay on that monthly return path and average 5% per month, within 8 years, you'll build a portfolio to $1 million. 8 years, $1 million, and never need to add a single penny to your account. That's how powerful this program can be for you. It's also why we say it is the only step-by-step plan designed to create millionaires. It includes everything you need to achieve financial success. You'll have the plan, just as I've taught it to you here tonight. You'll have the decision triggers and the Millionaire Blueprint rules, just as you've seen them in action here tonight. You'll have the right stocks to use with your triggers in your plan based on the simple one-number formula, just as you've learned how to do it here tonight. And tonight, I'm giving you a choice. You can join our Millionaire Blueprint family and speed the growth of your portfolio, or you can risk going it alone. I'll remind you, though, that going it alone could mean it takes you 30 to 60 years to reach your financial goals. If you want to save yourself 52 years, then I want you to reserve a seat tonight in the Millionaire Blueprints table right now. You can choose to join us with our simple, no-hassle, 60-day test drive for $79. That gets you complete access to the entire program. We don't hold anything back. We don't hide anything from you. You get absolutely everything, and I'm about to share with you exactly what you get. I will put a quick link up in the admin notice box so that you can all get to that page right away to start reserving your seats. There will be a time limit, so that should be up for you now. There will be a time limit. There's also a deadline. I'll cover those for you in just a moment. But again, that it gets you complete access to the entire program, no half access, no limited access, 100% complete and total access for the next 60 days for $79. Now, here's exactly how the program works for you. If you're ready to reserve your seat, look in the chat box. You can use the link in the admin notice box, or click on the pop-in box that's next to the chat tab, and that will give you the link to get right in to reserve your seat right now. But here's exactly how the program works. First, our Millionaire Blueprint investing expert, Jamie DeLugas, makes new monthly trade recommendations at the end of every single month. In fact, he'll be making his recommendations this weekend for February, so you're just in time. Now remember, this is short-term investing, not day trading, and our goal is to turn over our portfolio as frequently as the market will allow so that we're compounding our money from month to month. That's the hyper-compounding strategy that we use to get that explosive growth in your portfolio. Now, I told you earlier, or I should have told you earlier, that our maximum holding time is about 90 days, but you've already seen how quickly some of these trades can move in your favor, some of them in as little as 9 days. Next, you'll enter your trades on the first day of each month. I'll point out here, we're not market timers. We're not technical traders. We're not using some weird convoluted scheme. Quite simply, we want to get in, get our money working as fast as possible, which is why we use the first trading day of each month. Now, once you've entered your trades for the month, you simply follow the rules. Those are your decision triggers. We'll be guiding you along the way every single week, so you're never alone. And just like I showed you with American Airlines and US Silica, when there's a decision to be made, you can be secure in knowing that we're going to tell you what that decision should be and why that decision is the right one. So you'll get updates and alerts every single week when there's an action to be taken. That includes email and text message alerts so that you always take the necessary action when it needs to be done. When our 20% triggers are reached, we'll close the trades, take our gains, and move on to another opportunity the following month. Now, unfortunately, there are a lot of you here and only 21 seats. So no fighting over the seats, folks. But I want you to get in. I want you to do it now. You need to act quickly because there's also a deadline of Sunday at 7 p.m. Eastern Time. That's when our next monthly stock selection report will be in your hands, so that you can enter your first trades on Monday, February 2nd. Now, that link is up in the admin notice box. You can also use the pop-in box to the right of your screen to get the instant link to reserve your seat. Again, do it immediately and save yourself that 52 years. But once you join, and we'll start doing Q&A here in just a moment. Once you join, here's exactly what you'll get. First, you'll get the $1 Million Portfolio Blueprint. We have the 2015 version of this report coming out very soon to all of our members, but you can get the old version, but you'll also get the new one. That details the portfolio plan, the 2010 rules, and the short-term investing plan, everything I've taught you here tonight. Then each month, as I said, on the last day of the month, you get your Millionaire Blueprint monthly stock selections. That includes the complete short-term investing portfolio, which is between 5 and 10 selections, depending on how many open buckets we have each month, and to be used with the 2010 rules to investing. You also get access to our Millionaire Blueprint members-only website, where you get everything you need in one simple place. Trade alerts, updates, all the reports, all the bonus materials, everything in one easy-to-access website. You'll also have trade alerts and regular updates every Tuesday and Thursday by 7 p.m. Eastern Time. You'll get our midweek updates. Every Saturday morning is our comprehensive Saturday review, where Jamie gives you an in-depth look at all of our open trades, the returns for each trade, and key events driving our stock selections higher. You'll also get our action to take alerts via email on the members website and via SMS or text message if you choose to take that. So whenever we want to close a trade, you'll know exactly when to take that action. You also get bonus reports. Our Advanced Profit Strategies report teaches you how to use two simple strategies. Our risk reduction strategy, which shows you how to recapture your trading costs and eliminate nearly all risk in any trade you make. And the active investor rules, which show you how to capture larger gains from a winning trade by doing just one thing, just as we showed you with American Airlines and Meritor. Plus our $2,500 plan report. I told you earlier, this is for those on a more of a limited budget who need to get from $2,500 to $10,000. This report will help you make that move to get to that $10,000 point in about 12 months while still following the Millionaire Blueprint plan and the 2010 rules to investing. And finally, our capital management spreadsheets, they do all of the work for you in managing your 10 buckets in the program. I mean, there's even a training video to help you use these simple Excel spreadsheets in your very first month so that you can hit the ground running, but you simply enter in 3 numbers and the sheets do all the work for you. So again, we do all the work for you. You don't have to do anything in this program. You also get our Millionaire Hotline email. This is important because it's direct access to me and Jamie via a special email account so you can get your questions answered fast. It's your lifeline for instant help. You get all of that in our no-hassle 60-day trial for just $79. No other program provides a complete step-by-step investing plan where all of the work is done for you. Again, you get the $1 Million Portfolio Report, the members-only website. We have a special bootcamp video, which essentially is your fast training video. 2 months of stock selection reports over those 60 days. That's 10 stocks each month, so 20 total stock selections in the next 2 months. The ongoing trade alerts, email updates, the Saturday reviews, the 2 bonus reports, the capital management spreadsheets, our instant answer Millionaire Hotline email support. All of that for $79 for the next 60 days, but the deadline is 21 seats or Sunday at 7 p.m. Eastern Time, whichever happens first. So reserve your seat right now. We'll start doing Q&A here. Give me just a moment to back up and pull on the question screen and start pulling in some of the questions here. Give me a moment to catch up here. The Alamo is not a tourist trap, it is a church. All right, Ted asks, can I use options? For everyone who's going to make options-based questions, no. And I'll tell you why. In our program, we do not use options. The first reason is because not all of the stocks that we recommend are optionable. The second reason is because not all of the investors in our program have the experience to trade options. And the third and most important reason is because although we have a very high probability of hitting our 20% targets, we can't tell you when that will be, which makes it difficult to choose whether you should trade a monthly or a weekly option, which strike price, should you be a call or protective put, are you buying, or are you selling? Unfortunately, there are too many ways to play options for us to say this is the best strategy to use using options. What we have found instead is we do what we do best. We pick the right stocks, we follow our rules, we take our gains when they happen, and we repeat the process the next month. If you're an intelligent options trader, if you know what you're doing, you will be able to construct your own options trades to either limit your risk or enhance your profit based on your own experience. But thank you, Ted. It's a good question. Trent, stop loss order is based on purchase cost versus loss trigger based on % of current value. No, all of your loss triggers are based on the entry price. All of your triggers are based on your entry price. Your profit trigger is based on your entry price, and your loss trigger is based on your entry price. So if your entry price is $10 and your 20% profit trigger is, you have a 20% profit trigger, then your profit target is $12. $10 times 20%. $11.20. I'm sorry. I may need a calculator. I've been doing this for too long tonight. Your loss trigger is 10% of that entry price, which would be essentially $1, or from $10 down to $9. So 20% above your entry price, 10% below your entry price. It doesn't change. In other words, once the stock starts to move in your favor or even against you, you don't modify your targets or your triggers. You leave them where they are. That's why they're there. They are the decision triggers. They are the ones that are telling you what to do when an event happens. So when you hit that profit trigger, you're taking your gain. You hit that loss trigger, typically you'll be closing out a trade. So hopefully that cleared that up for you, Trent. Good question. Myrtle asks, do you buy blue chip stocks or penny stocks? We may from time to time buy blue chip stocks. We do not use penny stocks. Thanks for the question, Myrtle. Good question. Walt, how does this perform in a bear market? Good question, Walt, and two answers to that. Number one, in a bear market, we have something that most investors don't have. We have flexibility. Remember, you have 10 buckets in the short-term investing portfolio. Now, let's say that the market starts to roll over. It rolls over by 3 or 4 or 5%. We can step aside. We can stand aside from the market and sit in cash in some of our buckets. We did that back in July and August of last summer. We actually left 3 to 5 of our buckets in cash at the end of July and through the middle of August, when there was obviously a rather severe downturn in the marketplace. I think we need to be careful about bear markets. A couple of things on bear markets. Remember that a bear market is always shorter in length than a bull market. Even in 2008, 2009, how long was the crash? 4 months, 5 months max. September, October, November, December, January, you had a secondary low made by March, and that was it. It was done. So within 6 months, the bear market, so to speak, was over, and stocks started to recover. The second thing about bear markets is to remember that not all stocks go down in a bear market. Very important point. Not all stocks decline in a bear market. You can still find value-driven stocks, stocks that have potential for growth, even in a bear market. You're going to have new leaders that emerge at the back end of a bear market. A bear market is a good thing. Everyone's afraid of them, but it's a good thing. It cleans out the stock market. Think of it as an enema for the stock market. I can't believe I just said that, but it's true. It cleans out the worst of the stock market. It gives everybody a chance to start over. And I don't mean start over from zero, but if you have a set of rules, if you're protecting yourself, even in any segment of your portfolio, I don't care if it's long-term, if you're buy and hold, whatever, have loss triggers in place. Whether they're 15%, 20%, 25%, I don't care. Have a loss trigger in place. You will not lose all of your money like most people did in 2008, 2009. You won't be afraid of a bear market. Now, the other part of the bear market is we also have the ability to utilize inverse ETFs in place of stocks during times of extreme volatility in the marketplaces. We've used the VIX, we've used the TBT TBFs, which are the inverse ETFs for U.S. Treasuries. We've used the DXD, the inverse ETF for the Dow. We've used the inverse ETF for the S&P 500, for the Russell 2000. So you can insert index or even commodity-based ETFs from time to time. You can't use all of them. You have to be careful about them, but you can use them to hedge against a downturn in the market, a corrective phase in the market, even potentially a bear market. So there are certainly opportunities to do that. A key thing, the reason we don't strictly use ETFs, however, is because we are looking for those stocks that have that one number to them, that negative PE gap. So the problem with trying to apply that to an ETF is you can't validate or quantify a PE gap against a basket of stocks. So but that's again another strategy which allows us to be able to protect ourselves but still have an opportunity to profit even during a bear market. So good question. Thanks, Walt. Appreciate that very much. Let me move up here. And Dan, is that typical for airline stocks because of the risk? Not sure, Dan, what that question was. If you're still on the webinar here, if you meant the downturn in the airline stocks, but if you have a chance, feel free to just update your question for me so I know what you meant if it's not too late. Eli, is this being recorded? Yes, it is being recorded. Sounds like the program is paying for their trade suggestions. Yes, it is. On an average month, it does, David. It's a good point, good question. We've been averaging about 6.5% per month. So, if you're starting small, which is what I always recommend, if you haven't traded with us, this is why we do a 60-day trial. You don't know Jamie, you don't know me, you don't know the program. You have to get used to us. You will find that you have an ongoing dialogue with us, whether it's by our reports via email or on the weekends. You'll find that we're a steadying force for you when things go wrong in the marketplaces. We're going to have times where we're going to have to give you bad news. You know what? The stock hit a 10% loss. We need to close this trade. There are times where we're going to be able to give you good news. We just had 3 stocks in a row that hit their 20% targets. We did that back in November. That was a really fun email to send when you get to tell people they get to close 3 winning trades at one time. Let me see. Robert says, I saw how to calculate the PE, but I didn't get the calculation of how to calculate the earnings calculation. Boy, that was a lot of calculates in there, Robert. Hang on, and let me back up, and I will show you that process one more time. And so here we go. For Robert's edification, and for anybody else who may have missed this particular slide, remember that once you have the 3 numbers you need, the current price, the current year's earnings estimates, and the next year's earnings estimates, you're doing 2 calculations. First is to calculate price to earnings, which is the current price divided by the current year's earnings estimates. In the case of American Airlines, that was $51.40 divided by $5.72. That gives you a result of 9. So your PE ratio is 9. Just below that, Robert, is the calculation for the earnings growth rate. To do that, you take next year's earnings estimate divided by the current year's earnings estimate. So in the case of American Airlines, our next year's estimates, which if you're looking at the little graphic on the right side there, you can see next year, December 15, $8.42. You take $8.42 and divide it by the current year's estimate of $5.72. That gives you a 1.47 return. To get a percentage, you would subtract 1, so here you would get 47%. That would be the earnings growth rate. That's how you calculate the earnings growth rate calculation. Calculated for you by us every month. So, Penny says, I have a portfolio of 25 stocks. How do I make the transition without losing a bunch of money on positions I already have? You take a small piece of your portfolio. If you already have a portfolio of 25 stocks, you can do one of 2 things. You can either, if you have additional capital that's not in play, then you can use that capital to start. If not, then what you can do is exit without, if you don't have losing positions, exit profitable positions and turn that money back into the portfolio. That's certainly one thing that you can do. Mike says, thanks, think it over, bye. Thanks, Mike. Have a good night. Henry says, can it be done with 5 or 7 stocks, and how do you decide what stocks to buy at the end of the month and which ones to get out of? It can be done with fewer stocks. Again, we do have people who are using $2,500 to $5,000 to begin the program. With fewer stocks, again, the main thing is to make sure that you are equally weighted in your capital buckets. So if you have 5 positions, for example, 5 buckets, you want to make sure that those buckets all start out at the same dollar amount. So for simplicity, if you were starting with $5,000, 5 buckets, $1,000 per bucket. That's number one. Second part here is what stocks to buy at the end of the month. That's the process that Jamie goes through at the end of every single month. He has a computer-based algorithm that runs and ranks stocks for him, and then from that output, he's looking at basically the top 50 stocks, and he's narrowing that down to a top 10, and then that top 10 is based on the one number approach that we taught you here tonight. How do we decide which ones to exit? There are three ways that we look at stocks to exit. Number one, if a stock is, say, moving sideways over a period of 60 to 90 days. Remember, the longest we really want to hold any stock is up to 90 days. So if a stock just isn't getting any momentum for some reason, we will typically let that stock go and move on to another opportunity. A second reason that we will decide to let go of a stock is if it's in a profitable state. If we've achieved a 20% target or a higher target, then we will sell that stock and close that trade and move on to another opportunity. And the third reason that we'll close a trade is if something fundamental has changed about the company and we think that that has increased the risk of downside, a downside move to a particular stock. So those are the three typical reasons that we would do that. So can I use this on any platform? Schwab, yes, you can. If you can buy and sell a stock, you can do this. Christopher, your projection of 8 years is only valid if conducted in a tax-deferred account, not necessarily. William, it should not matter where you place your trades. Okay, yep. Thank you for taking care of that one, David. David asked how much after the 60 days. It's $79 after the 60 days, or we give you an annual upgrade where you can save 60% off the annual cost after the trial. Joe, since this is short-term, aren't the taxes about 50% of the amount you make yearly? No. First of all, remember, your tax situation is different from everyone else's. So are taxes an issue? Yes. But you're not going to. It's not like you're going to lose all of your money to taxes. Secondly, the biggest mistake investors make is failing to make a decision because they're worried about paying a tax. I know it sounds counterintuitive. I know nobody likes to pay taxes. If you're paying taxes, you're making money. This is the easiest lesson to learn. The more taxes you're paying, the more money you're making. Paying less tax isn't doing you any good because you're not paying money. You cannot be afraid to make an investing decision because you might have to pay taxes on something. Yes, you would be liable for short-term capital gains taxes. I would recommend if you have an investment professional, an accounting professional, obviously talk with them first about whether this type of program is right for you. Remember that you're not making you're making a limited or finite number of trades every month. So you will have some exposure to taxes. We do detail some of that issue in the advanced version or the new version of our 2015 $1 million portfolio blueprint report. But you can't make a decision negatively just because you might owe a tax. But I understand where you're coming from, Joe. Believe me, I know. Great info. Thanks, Mary. You're welcome. I would think this is best for retirement accounts. I would agree that it is. It doesn't have to be, but if it's in a Roth IRA or any other tax-deferred account, obviously that's the best place for it, but it doesn't have to be. How long of a track record? We showed you that. That was 15 months. Let me scroll back to that. Give me just a second. Right there. Those are all the months, David. Will this work in volatile markets? Yes. But you may find yourself holding some of the stocks a little bit longer than 30 days. You will find yourself holding those stocks into the 60 or 90-day time frames during volatile times because you have to withstand the volatility in the marketplace. But remember, when you're looking for a momentum move, you're only going to get that during volatile times. If the market's blah, it's not moving. So that's not going to propel your stock higher. So it's a conundrum because you need to have volatility, but you need to have a limitation on the amount of volatility you get there. So good question, though, Matthias. Thank you. Lacey, what is the monthly fee after the 60-day trial? $79. I think we got that one. Okay. No. Reserve seat or wait for trading when account is fully funded. If you need to wait for funding an account, you can hold out until the end of February and see if we have seats available going into March. The other thing is you can also just sort of ride the sidelines for the first month and see how we work with you. See what types of trades and recommendations we make. See how those trades work out. See how the communication process of our Tuesday, Thursday updates, our Saturday review, our monthly stock selection report, trade alerts, etc. You can dry trade for a month. and then jump in the next month. So absolutely, you could do that. Are you dividing your cash between the 10 buckets, asks Greg. Yes, you are. And you'll discover you want to, about every 90 days, rebalance. The key thing here is, because of the risk management practice that's built into the portfolio, you want to keep making certain that your portfolio is divided by 10. We have other strategies for larger portfolios, which we share with you in our upcoming report. So absolutely, you want to keep that cash equally weighted between those 10 buckets. David, when it is getting close to the 10% loss trigger, would the market makers hunt it down more readily? Only if it were a hard stop loss order, David. That's one reason why we don't use stop loss orders on a lot of our stocks. The loss trigger, once a stock goes down basically 5 or 6%, it's basically on our radar, if you will. It's the DEFCON 3 kind of green, yellow light flashing in the background. Once it gets down to their point, we're then watching it every day. Jamie's going back to redo the fundamental analysis. He's looking for news. He's looking for why is the stock down, and what's the risk? What's the downside risk? If it gets to that 10% floor, that's when we tell people to place their orders, exit. We give you exact exit instructions, and in part it's to prevent that stop loss hunting possibility. With smaller stocks, I would argue that possibility, it becomes a probability. With larger cap stocks, not so much. You have too much volume backing larger cap stocks for that to be the issue. So that's why we don't do that. The reason we don't use trailing stops is because of potential whipsaw. David, it's a good question, actually, and one that a lot of people I don't see asked very often. The reason we don't use trailing stops is to prevent the stock goes up 5%, right? So your stop loss trails, say, up 5%. So now you have a minus 5% stop loss, and all of a sudden the market just rolls over one day and your stock goes down 10%. Boom, you're stopped out at minus 5%. And then what happens? The stock turns around and goes right back up. That's the danger in using trailing stops at the outset. We will from time to time, and we have from time to time, instituted a 5% trailing stop when a stock has hit its 20% target. Now, there you're protecting 15% essentially of your gain. And that makes much more sense, because now your risk is only 5% of profit. It's not 5% of loss. That's the difference. So good point, good question on trailing stops. Actually, that's one of the things that we teach in the Advanced Profit Strategies report, ways to use trailing stops and tighten them up as a stock continues to run. So great question, David. And then he says that sounds like you're giving 2 months for the price of one. Yes, we are. Do you take into account dividends in this approach? No, we don't. And what we'll always tell folks is, if there's a dividend, just take the cash dividend. And the reason is because you're not in this stock for the dividend. The dividend is sort of like think of it as a bonus. If a stock that we recommend pays a dividend, just take the cash dividend. Do not reinvest it, because remember, these are typically short-term investments, so you don't intend to hold the stock longer than 90 days, which would essentially be one dividend period. Do you hold stocks for X dividend dates before exiting a winning position? Do you hold stocks for X div dates before exiting a winning position? Not necessarily. If we're at a 20% target, we're going to take that 20% gain. The X div possibility isn't necessarily going to affect our decision. The only time it might affect our decision is if we're sitting at like a 15 or 18% gain, and we know that there's a stock that has a tendency to fall dramatically with following an X div date. We might tell people to take an 18% gain versus a 20% gain, simply to eliminate the downside risk. That's a great question. Who manages the portfolio, asks Win. You do. Can you stop the subscription at any time, Lacey asks. Yes, you can. When is the 2 boot camp training? Actually, Helena, that was a typo on my part. The boot camp was recorded in January, just last month, with a large group of new members that we had. That video is available as soon as you become a member in the members area. So as soon as you join, you can go right to that video and watch that boot camp video. I would set aside some time to watch it, though, because it was allowed about 45 minutes of teaching and then about an hour of Q&A with the members. So we stuck around for a long time on that one. Uh, Ennis, instead of investing 1,000 each bucket, with 2,000 make it faster? Uh, sure, yes, it would. Because you're growing, you're already starting out twice as fast. So remember you're doubling now your profit. You're not changing your risk profile just because you have more capital invested in each bucket. So you're certainly capable of doing that. You are going to move a little quicker. You move a lot quicker, actually. So, see, Jerry asks, how do you buy $100 stock with $1,000 in the bucket? You buy fewer shares. It's a good question, Jerry, and let me help you on that one very quickly here. Very important point is the price of the stock isn't relevant. Remember that you're after a specific percentage gain in the stock. So the price of the stock doesn't matter. Now, we typically do not recommend stocks that are above $200 a share, because obviously you can only buy a limited number of shares. But a 20% gain on a $200 stock is the same as a 20% gain on a $100 stock, or a $50 stock, or a $10 stock. Because if you're starting with $1,000 and you get 20%, it's $1,200. It doesn't matter whether the stock was $200 or $5. The number of shares doesn't affect the return. The percentage is the only thing that matters. Very important lesson and a darn good question. So Penny's going to be I think the last question here. I think we're down to the last couple spots. So are all the stocks recommended in your service of large enough volume so that your members don't move the stock price? We have not seen any evidence to the contrary. We have not seen any evidence that the number of people in the program affects the price of the stock. So I would argue that, yes, they are of large enough volume. We do have volume requirements on our stock selections, so it does help us to protect members from buying a stock that just moves way too rapidly. So there you go, folks. Once again, just a quick wrap up on, I'll hold up for one more second for last questions, or if there are any last questions, but millionaire-blueprint.com/go. Been a pleasure. Thank you all for taking time to join me tonight, and we will update everybody as we go along, whatever seats are available. And I think that's it. That's all I have for you tonight. So appreciate you joining me tonight, and good luck to all of you in your investing. Have a great night.